Welcome everyone. Today we're bringing some absolute focus and honestly a lot of enthusiasm to an incredibly powerful approach to the financial markets. We're talking about the top-down trading strategy. We've gone ahead and distilled a massive mountain of data, research, and institutional outlooks to bring you this explainer. Think of it as your ultimate beginner's blueprint, and it's tailored specifically for the really fast-paced, highly volatile market regime we're seeing in 2026. So if you've been struggling to find consistency out there, well, you are in exactly the right place. Let's get into it. Okay, so let's tackle the elephant in the room. It's the ultimate question, isn't it? Why do 99% of traders actually fail? Our sources point out a pretty fascinating reality here. It's not because they don't know how to spot a basic support line or a candlestick pattern. Nope. They fail because they're trading completely randomly. They zoom way in on a tiny 5-minute chart, hit buy or sell, and totally ignore the massive, overarching market direction that's actually driving the price. It's literally like trying to swim upstream against a roaring river of institutional capital. You're just going to get swept away. To fix that, we're going to follow a highly structured path today. First, we'll look at the macro context. Second, the higher timeframes. Third, the analysis timeframes. Fourth, the entry timeframes. And finally, we'll wrap up with your essential 2026 trading rules. I want you to think of this 4-step approach like a giant funnel. It's your master filter. Notice how we start at the widest possible global lens, that's the macro context, and then we progressively zoom in step by step. We're essentially filtering out all the daily noise until we reach the exact minute of your trade execution. The golden rule here, you never start at the bottom, you always start at the top. Alright, step 1, analyzing the macro context. This is all about assessing the global weather of 2026. Right now, we are seeing some massive structural shifts dictating the primary flow of money. Take the newly implemented One Big Beautiful Bill Act, or OBBBA. This is fundamentally restructuring tax codes to incentivize domestic manufacturing. Meanwhile, artificial intelligence, it's moved way beyond just software now. We're talking physical infrastructure, data centers, power grids, the whole shebang. Throw in non-recessionary rate cuts from the Fed, and what we're seeing is capital aggressively rotating from bits to atoms. Money is moving straight from speculative tech into the real physical economy, like industrials and energy. So, the crucial takeaway here is that you have a choice. You can be the random trader, right? The guy blindly reacting to a noisy 5-minute chart while totally ignoring the fact that literally billions of dollars are flowing into energy infrastructure today. Or you can be the top-down trader. Someone who actually understands the macro reality, knows exactly which sectors have a fundamental tailwind behind them, and uses a structured blueprint to capitalize on it. Moving right along to step 2, the higher time frame. This is where we build our strong foundation. Okay, let's really unpack this concept because honestly, it is the absolute secret to consistency. Think about it. It takes 7 full days to build a single weekly candlestick. All the buying, all the selling, the breaking news, the algorithmic flows over a whole week, it's all packed into that one candle. That makes its structure infinitely stronger and more reliable than some random 15-minute fluctuation. If the weekly chart is pointing up, the overall momentum of the market is up. It's really that simple. Consider this your ultimate roadmap for the charts. The higher timeframes dictate the overall trend. For example, if the daily chart is in a bullish uptrend, you are strictly looking for reasons to buy. That's it. You don't try to guess the top, and you absolutely don't fight the trend. This is where you mark your major support and resistance levels because those are the heavy lines in the sand that the big institutions actually respect. Step 3, the analysis timeframe. Now we're moving from the foundation to erecting the walls. Now, the fun begins. This is where we hunt for the exact zones where smart money operates. On the 1-hour or 4-hour charts, we're basically playing detective, looking for specific footprints. We're searching for order blocks, which is just where big players left unfilled orders, or fair value gaps caused by super aggressive buying or selling. We're also keeping a close eye out for liquidity sweeps. You know, when the market dips just low enough to hit everyone's stop losses before suddenly reversing. Yeah, that's where you form your highly specific intraday bias. Down to step 4, the entry timeframe. Let's call this the interior design. Alright, here is exactly how you combine all these timeframes to actually execute a trade. And listen, this requires immense discipline. You only execute on the 5-minute or 1-minute chart when all the higher timeframes align perfectly. So, if the daily foundation is bullish and the 1-hour wall taps into a demand zone, you wait. You drop down to the 5-minute interior and you look for confirmation, maybe an engulfing candle that proves buyers have actually stepped back in. That right there is when you enter and you place your stop loss logically below that fresh structure. Finally, step 5, the 2026 trading rules. It is all about protecting your capital. Look, this is the #1 law of trading. It's echoed by literally every single professional source we analyzed for this explainer. Cut your losses short. Being stubborn, sitting there hoping a bad trade is magically going to turn around, that is what destroys accounts. Quick exits, on the other hand, they preserve your capital so you're locked and loaded for the next high probability opportunity. To make sure you actually do that, you need a checklist. By systematically running through a checklist every single day, you completely remove emotional decision-making. First off, you must practice on a demo account. No exceptions. When you go live, risk absolutely no more than 1 or 2% of your capital per trade. That way, a single loss never wipes you out. Build a rigid daily routine that filters out all the noise. And please, never arbitrarily increase your position sizes just because you feel like you're doing well. This checklist replaces the pure chaos of modern trading with structured, repeatable mastery. So, here is a provocative thought to leave you with. Think back to your last few trades. Be honest. Were you the random trader reacting to noise, or the top-down trader with a plan? I challenge you to apply this powerful 4-step framework: macro, higher time frame, analysis time frame, and entry time frame to your very next session. Start with that big picture, and just watch how clearly the market begins to reveal itself to you. Thanks for joining us for this explainer, and stay disciplined out there.